Welcome to another Reserve Ruehl. My name is Keith Ruehl from Global Solution Partners. Today's topic is the new Fannie Mae and Freddie Mac guidelines. Why should I care? Let's start with a quick refresher on Fannie Mae and Freddie Mac. Unlike FHA, VA, and USDA, Fannie and Freddie are not government agencies. They are government-sponsored enterprises. Fannie and Freddie's primary purpose is to support home ownership and maintain liquidity in the mortgage market. They do this by purchasing loans from large banks, mortgage brokers, community banks, and other lenders. Once they purchase a loan, they bundle them as mortgage-backed securities and sell them to investors all over the world. To help mitigate the inherent risk with purchasing loans, Fannie and Freddie set guidelines that lenders must follow in order to sell their loans to Freddie and Fannie. On March 18, 2026, Fannie and Freddie updated these guidelines, potentially impacting the approximate 150,000 condo associations and co-ops across the country. There were 4 significant changes. Number 1, increasing the minimum reserve fund levels from 10% to 15% of an association's annual budget. Number 2, eliminating the limited review. Think of that like previously getting a reserve study was a suggestion, and now it's a homework assignment that's going to actually be graded. Number 3, requiring reserve studies to be updated every 3 years. Number 4, eliminating baseline funding as an option. In other words, they want to see some financial cushion in the plan. Why did Fannie and Freddie update these guidelines? They are appropriately concerned about the increased risk associated with neglected infrastructure within communities. The tragedy in Surfside was a horrific example of what could happen. And they understand that the best way to mitigate the risk is through proper planning and ongoing maintenance. Hope is not a good funding strategy. If you are a part of an association where the board members are already properly fulfilling their fiduciary responsibilities, then these changes may be moot. However, there are likely tens of thousands of associations that do not have a current professionally prepared reserve study and are not properly funding the reserves. Those associations run the risk of not meeting the Fannie and Freddie requirements, and therefore potential buyers in their communities being denied for loans, which ultimately could negatively impact the property values. A potential buyer having an 800 credit score, terrific job in putting 20% down, may actually get denied because of improper reserve funding within the association. Key takeaways for today. Number 1, make sure your association has a proper reserve funding plan in place. Number 2, officially update your plan at least every 3 years. And number 3, perform scheduled maintenance and replacement per the plan. If you have any questions or want more information, please don't hesitate to give us a call, send us an email, or visit our website at globalsolutionpartners.com. Thank you for viewing today's topic, and we look forward to working with you.